Could Snowflake grow into the next mega cap tech company that rivals the likes of Adobe, Salesforce, and ServiceNow in terms of market cap right now? So one's sitting at right about $60 billion. If we can get to maybe $200, $300 billion in market cap over the next few years, well, then you have significant growth over at Snowflake that you can capitalize on. We'll talk about their Q1 results, which came out after the bell. We'll take a look at guidance this company also mentioned. And with Snowflake, we'll take a look at some important metrics like their net revenue retention rate, see what that says about a business like this. We'll also take a look at the valuation, and some things actually might surprise you here. With Snowflake, we have to, of course, dive into the financials, as this company will put out a ton of infographics, but really what you have to do with businesses like this is actually comb through the numbers, and we'll do that for you here on the channel. And then when we get to the technicals, you actually could have signs of a breakout here with Snowflake, which could present some interesting trading opportunities as well. So you definitely want to stick around for that. Hey guys, hope you're doing well out there. If you are new to the channel, find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of Snowflake rallying nearly 7% in the after hours, trading up to $192 a share. Year to date, you're up about 18% over the past 1 year. You're up close to 10% on shares of Snowflake. This is one of those high beta names. So over the past month, I mean, you've seen your shares move higher by nearly 30%, but you do tend to swing pretty wildly with shares of this one. As you see, the 52-week range, the lows sitting at right around $107 a share. So the important thing with a name like this is to pick it up at the right point. And speaking of the right point, maybe now is the right point, or maybe soon will be the right point to step into shares of Snowflake. Now, Q1 revenues came in at just a shade over $1 billion, growth of nearly 25.5%, beating estimates on Wall Street by right around $30 million. So that's, I mean, good sign number one. This company now beating those expectations. They also came in with a non-GAAP earnings per share beat, about 26 cents per share. Now, this company does have two revenue segments, the product revenue and the services revenue. Of course, the product makes up the majority, the vast majority. This company's business, right around 96, 97% of their overall revenues comes from the product side, just a shade under $1 billion. That represented nearly 26% growth on a year-over-year basis. Now, the other metric Snowflake likes to provide is the net revenue retention rate. This thing coming in at 124%. Now, to break down the net revenue retention rate, it's essentially if you were to take the existing contracted customers, you add on maybe any expansion or any upsells they did for those customers, and then you subtract out any contractions along with any churn of those customers. So maybe customers canceling or leaving the Snowflake platform. Well, if you net that out, you get to right around 124% retention rate. So the reason this is important is because if you notice, the 24% from this 124% actually mimics your overall revenue growth pretty similarly. So what that should tell you is the vast majority of Snowflake's overall product revenue growth is actually coming from existing customers. What they're doing is once they get those customers on contract, they're likely upselling those customers, maybe expanding out those contracts on larger and larger deals. And so because your net revenue retention rate actually mimics your growth rate pretty in line, tells you that the majority of that revenue growth coming from upselling those existing customers, and then you're getting a little bit of growth from any new customers. And so likely what Snowflake does is they give really good deals and really good rates to their new customers to get them on board. And then once they're on board, likely they'll stay on and continue to expand that contract value over multiple years. So that tells you a few things. First of all, churn over at this business is actually pretty low, especially if you have your net revenue retention rate higher than 100%, you're expanding faster than you're contracting. And then on top of that, because the revenue retention rate mimics your revenue growth rates, well, tells you most of that revenue growth comes from existing customers. The other thing it tells you is that the company actually probably has a pretty damn good product and a pretty sticky product that customers continue to use. On top of that, they're continuing to expand customers on a 12-month revenue rate that exceed $1 million. So again, adding on larger and larger customers as well. And then the other thing is the remaining performance obligations totaling about $6.7 billion, growth of nearly 34% year over year. Again, this growing faster than your revenues, also a good sign, telling you that they're signing longer and longer deals and probably larger and larger deals extending out into the future. These are revenues they simply haven't recognized yet, but that could be on contract, maybe deferred revenue, maybe some non-cancelable contracts as well. So I mean, things from these figures look good. I mean, if it tells you a story of the business, it tells you that the business is doing well. Another indication that the business is doing well is the fact that outlook was just raised. So Snowflake did raise full year product revenue outlook up to 4.33 billion. Previous range was for 4.28 billion. So adding on about $50 million to the full year product revenue side, again, coming in higher than analyst anticipations. And then for the second quarter, they're also raising a little bit of that top line revenue growth of 1.035 billion up to, call it right around 1.05 billion. Analyst expectations were right around 1.03. So near the low end of what the company is guiding for. So that's, again, a good sign that outlook is coming in stronger than expected. And as you look ahead into the next couple of quarters with Snowflake, you see a very prominent trend that analysts expect this company to grow in the low to mid 20s for the next, call it 2 to 3 years. I mean, you get into fiscal year 2028, which is really calendar year 2027. So you look out about 2 to 3 years ahead, this company is still expected to grow in that 20% range. Now, the growth rates absolutely have slipped over the past few years. I mean, they were growing at 70% and then 50% and then 30%. Of course, as the numbers get larger and as contracts get bigger, well, those revenue growth rates certainly are unsustainable. But you see this company, if they can absolutely maintain this right around 20% growth rate into the near future, well, then a valuation like this can absolutely be grown into, especially considering the fact that they're anticipating about $4 billion in full year revenues. You look at a company worth around $60 billion, this company actually can certainly grow into its valuation from a price to sales perspective. And speaking about a price to sales perspective, right now trading at about 17 times a trailing 12-month price to sales. Like we said, I mean, you tack on 20% growth for 3 years, 5 years consistently, and the price to sales begins to come down very rapidly, especially if the valuation doesn't budge. And what I have is a comparison to other software as a service businesses. Some of these a bit more mature, like Salesforce and Adobe, certainly they're not growing at the same rate. They're growing somewhere between 8 to 12%. And so that's why you put a much lower price to sales multiple on it. But even a company like Microsoft, growing about, call it 13, 14, even maybe 15%, significantly slower than Snowflake, is still getting close to a 13 times price to sales multiple. And then the other thing is a company like ServiceNow, which I think is a very, very good comparison to Snowflake, considering they're in the enterprise SaaS business model. Will they get a price to sales multiple closer to 18 or 19 times? Now, one thing with ServiceNow is they are very high quality, much higher margin, also wildly profitable as well. And so Snowflake not quite there just yet, but I mean, if they're able to grow into these valuations by maintaining this 20% growth rate, if you really believe analysts on Wall Street, if you believe this company is able to hit these sort of growth rates over the next 2 to 3 years, well, this company can absolutely deserve this price to sales multiple. From an earnings perspective, from a cash flow perspective, I mean, things quite different with Snowflake versus ServiceNow, but from a sales perspective, things actually look pretty damn good over at Snowflake. Now, again, like I mentioned at the top, this company tends to provide you tons and tons of infographics. I mean, you pull up their investor relations and they'll talk about their different customers. They'll talk about different growth rates. They'll talk about different metrics. What you really have to do as an investor, especially at growth companies like this that tend to finance their business in the early years from a stock-based compensation perspective, is actually pull up the numbers, go through them, see if they make sense for your investing appetite. Now, from a statement of income perspective, we took a look at that revenue figure of $1.04 billion, good for nearly 25% growth year over year. Your cost of revenues also growing in roughly in line from 270 million, call it up to 350 million. And so your gross profit coming in right underneath $700 million. Last year, you were just above $550 million. So, I mean, things over at Snowflake from a gross profit perspective look actually pretty decent. They're looking at about 67, close to 68% gross profit margins. So those are being held steady. And again, you're getting that revenue growth and that is translating into gross profit growth. I think at one point, this business used to have nearly 72% gross margins. And so you have seen those come down just a little bit, but again, nearly 67% gross margins definitely gives you a lot of room to play around on your operating expenses side. Now, with your operating expenses, this company is spending a lot on sales and marketing, going from 400 million up to, call it $460 million. So again, you take this $700 million of gross profit, you subtract out 450 from sales and marketing. I mean, this company is having to spend a lot on their sales and marketing to get these types of revenue figures out the door. What you would want to see with Snowflake is, as this business matures, maybe they can pull back on sales and marketing. Maybe they can integrate AI more heavily and definitely pull back on some of these operating expenses, show some leverage there. On the R&D side, growing from $410 million last year up to $472. So you're also growing your R&D expenses. Now, just taking a look at sales and marketing R&D, right there, you have about $900 million in operating expenses, and that's already more than what you pulled off in your gross profit. So, I mean, it doesn't take a rocket scientist to see the issue here. This company has an expense problem. Despite growing those revenues 25%, their expense profile just seems a bit too out of whack. Now, keep in mind, this is on a GAAP basis, and I'll mention in just a minute how it changes from a non-GAAP perspective. But I mean, from a GAAP basis where you factor in stock-based compensation, things certainly don't look good. You also tack on nearly $200 million of G&A. Last year, you were at 93, now sitting at 209. One of those reasons is because this company did close off an office in San Mateo, and so they ended that lease and had to pay some impairment on that to the tune of about $100 million. So even when you strip that out, your G&A expenses did increase year over year, and your total operating expenses coming in at $1.14 billion. Again, despite just $700 million in gross profit, that leads to an operating loss right around $447 million, accelerating from same time last year of $350. But again, even if you strip out those one-time G&A impairments from that office lease, I mean, your operating losses basically sitting exactly where it was last year, right around $350 million. So you're not moving in the right direction from a GAAP perspective, and that's largely because your operating expenses remain really, really elevated over at Snowflake. This company is earning a boatload in interest income. We'll see from a balance sheet perspective, things look pretty good. And then from their shares outstanding, you do see those actually ticking down on a year-over-year basis, just slightly, but that is showing signs that this company is beginning to sort of flatten out the dilution on their shares. Now, from a balance sheet, it's really what you would expect from a company that recently went IPO just a few years ago. You're sitting at about, call it $4 billion in cash and short-term investments. That's along with nearly $1 billion in long-term investments. And then from a liability perspective, you actually don't have a lot of liabilities, most of them sitting in deferred revenue, which is basically obligations this company has given out to their customers, but hasn't actually collected the revenues on just quite yet. And so from a liability perspective, you actually don't have too much to be concerned with. Now, from a cash flow perspective, this is quite important to pay attention to, because this is where a company like this gets to add back a ton of those non-cash expenses that they're using to finance their business, at least at the current time. So you bring down that $400 million of net loss on a quarterly basis, but you also get to add back nearly $380 million of stock-based comp for the last 3 months. And if you've gone through Snowflake's earnings in maybe any previous quarters or previous years, it's a similar trend to what you would see. This company puts up a net loss and then gets to add back a boatload in stock-based compensation from a cash flow perspective. And so from an operating cash flow perspective, I mean, things look pretty good. You are at about $230 million in quarterly operating cash flows. Again, that is down from same time last year, but some of those is due to changes in those assets and liabilities. But again, all things considered, you are actually cash flow positive, at least from an operating basis. And so where they actually end up using that cash is, first of all, in terms of purchasing property, plant, and equipment. You see that actually did accelerate meaningfully year over year. You're wondering whether this is maybe some infrastructure spend on AI and data build out, and will this perhaps even continue over at Snowflake? Because if it does, well, then that changes sort of the capex this business does and the free cash flow it tends to put out. But then the majority of their cash flow, they actually put towards the use of a buyback in the most recent quarter to the tune of about $500 million. That is similar to what they did same time last year, about $500 million as well. So this company is actually using a lot of those operating cash flows and more towards a buyback, telling you that maybe management thinks right now shares are sitting a bit undervalued. But keep in mind, this buyback is simply just offsetting a little bit more of that stock-based compensation. So you're just mitigating that dilution with the buyback. You're not actually taking meaningful amounts of shares off the open market. So I mean, things over at Snowflake certainly do look better than they have in the past. I think the expenses remain a relatively big issue for this company because they're coming off such a large base. But what I do want to show is at least the trend is moving in the right direction. From a GAAP basis, the expenses as a percentage of overall revenues is beginning to go down. So you see those GAAP sales and marketing expense. Last year, they were about 48% of net revenues, now coming down to 44%. So at least moving in the right direction. Similar thing on an R&D. Last year, you were looking at about 50% of your revenue was R&D from a GAAP basis. Now that's come down to 46%. And then from a G&A perspective, you do notice that it went up from 11% up to 20%, but that does include that $100 million asset impairment related to the exit of that San Mateo office. When you take a look at it from a non-GAAP perspective, I mean, it's still, again, trending in the right direction as you see those percent of revenue figures decreasing from a cost perspective. So, I mean, look, things are trending in the right direction with Snowflake. The issue is that the numbers on the expenses side still seem very large. And especially despite how much gross profit they're bringing in, it's much, much more than the gross profit. And so profitability over at this company still remains a big question. The question is if this company can continue to grow these revenue figures in that mid 20% clip, and if they're able to continue to bring down those GAAP expenses, well, then in maybe a couple of years, this company can certainly have a viable business where they're churning out meaningful amounts of cash flow that are not just due to adding back stock-based compensation. Now, from a technical perspective, you do have some things to like here. First of all, you're trading near the top end of the range. And so if this company does get rejected, which is a pretty good chance, where you have a very predictable pattern, this company will likely come back down, at least in the middle of the channel here in the 155s, if not all the way back down into the low 130s. That's your point to continue to maybe dollar cost average, maybe continue to buy into shares of Snowflake, considering you have a huge range of consolidation from this 130, call it up to the 190 range. The other situation you could have, which I think is actually a pretty good possibility here with Snowflake, is because you're testing this $190 range. If you actually see a breakout with shares of Snowflake, maybe up to $200, you do have this gap in the chart that you need to backtest and fill, and these gaps tend to fill rather quickly. So what you could do is play the breakout trade here with Snowflake. Is if you get a breakout up to, call it $200, well, then there's a very good chance you're coming all the way back up here and testing these highs you made in the 230s, maybe even in the 240s. So one sort of trade you can look to play with Snowflake is pick up shares on the breakout, maybe right here at $200, set a stop loss at maybe 185 if you want to be a bit more conservative at 190. And so your downside is about $10 to $15, and you're looking for the breakout all the way back up to the 235s, maybe as high as $240. So you have about $40 in upside, call it about $10 to $15 in downside. That's actually a pretty good risk reward with a name like this. And one thing I would actually recommend with shares of Snowflake is actually taking profits whenever you get those breakouts, especially if you're playing the trade. Absolutely take the profits. But even if you're going long shares of Snowflake, it's actually not the worst idea to take profits with a high beta name like this, especially anytime you come in near the top end of your range like you are right now in the 190s. Especially, look, if you picked up shares somewhere in the 130s, 140s, you're actually probably offloading shares at the current point, because there is a chance Snowflake hits its head at the 190 range and gets rejected once again. This one has been trading in a pretty predictable range where you can actually look to swing trade it near the bottom and look to sell it at the top, at least sell portions of it to capitalize on some of that potential. Over the past couple of years, Snowflake definitely has begun to grow into that valuation, considering you're seeing huge amounts of consolidation despite the revenues continuing to increase over at this one. If that continues, I mean, if this one can continue to grow into the valuation and it just keeps consolidating, well, then it can absolutely one day become a buy for me. Currently, still a bit too much risk due to the lack of profitability, due to the big expense profile. But if this company can absolutely get those expenses in control, or at least grow into those expenses, well, it can absolutely be a company that one day is looking at a $300 billion valuation in the likes of ServiceNow, Adobe, and Salesforce. Certainly can be one of those mega cap tech names you could add to your portfolio. That was my take on shares of Snowflake. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.